Back in 1996, when Alan Greenspan first used the terms of irrational exuberance, he referred to excessive optimism in financial markets. We don't think that's the case now, as there are solid macro foundations that legitimate the current rally. Our growth nowcasters are indicating that current economic growth is well above its long-term potential, even though they showed signs of stabilization lately. In addition, central banks remain very accommodative for now, so yes, it is rational for markets to behave the way they have this year, but we consider that complacency has been growing recently. In our opinion, there are two major risks right now, one upside risk and one downside risk. The upside risk, the most probable in our opinion, would be a prolonged recovery, with growth running hot for longer and spilling over inflation pressures. Higher, less transitory inflation will force a swifter reduction in central bank accommodation, which would force a global repricing in financial markets. The downside risk would be growth faltering on the back of the COVID's Delta variant, delaying the full reopening of the economy and preventing the longer-awaited push in consumption and investment yet to be seen. The risk, though, would be investors' perception of future growth prospects, which is already the case with China now. So there are risks out there that could dampen optimism, and our internal risk appetite indicator has reached complacency levels, just like it did early May before the correction. Clearly, it's not. The global economic context remains exceptional, and we are confident it will remain very favorable over the medium term. However, reckoning the risk of a stress event over the short term, there is a need to increase hedges to cushion our central scenario against temporary corrections. We favor spread structures to avoid being outright buyers of volatility and benefit from a currently elevated skew. Another interesting hedge is being long the US dollar. We have a substantial position in our strategies, which could benefit both from flight to safety and from the upside risk scenario we discussed earlier, if inflation forces the Fed to act quicker on tapering than tightening monetary conditions.